In my last monthly portfolio update video, I revealed that I sold out of 3 different positions, and in this video, we're going to be digging deeper into what stocks I sold, why I sold them, and when you should consider selling a stock. The goal of my dividend portfolio is to one day have the ability to live off of dividend income, and with each stock that I invest into, I make sure that that investment will help me reach that goal. Ideally, the stocks that I buy should be quality businesses that I will never have to sell. Unfortunately, there are still a few reasons that I occasionally have to sell out of positions. To better understand the reasons as to why this may be, let's turn to the king of investing himself, Warren Buffett.
The sell situation has changed over the years because when I started out, I had way more ideas than money. I mean, I would go through Moody's manual. I went through it page by page, and then I went through it again page by page. And I found stocks in there that I could understand that were selling at like 2 times earnings, even 1 times earnings. Well, when you only have $10,000, that can get a little frustrating. And if you don't like to borrow money, which I never like to borrow money, so I was always coming up with more ideas than I had money. So I had to sell whatever I liked least to buy something new that just was compelling to me. And for a long time, I was in that mode. And now our problem is we have more money than ideas.
In that clip, Buffett explained the key concept as to why I sold out of my positions, and that concept is known as opportunity cost. Opportunity cost are the potential benefits that an individual, investor, or business misses out on when choosing one alternative over another. Understanding the potential missed opportunities when a business or individual chooses one investment over another allows for better decision making. Here's Buffett and Charlie Munger again explaining how they approach this key concept.
Best thing to do is buy a stock that you don't ever want to sell. I mean, that's what we're trying to do. Sometimes if we need money to move to another sector, like we did last year, we will trim from some holdings, but that doesn't mean we're negative on those businesses at all. I mean, we think they're wonderful businesses or we wouldn't own them. And we would sell, if we needed money for other things. The Geico stock that I bought in 1951, I sold in 1952. It went on to be worth 100 or more times before the 1976 problems, 100 or more times what I paid. But I didn't have the money to do something else. So you sell if you need money for something else. You may sell if you believe that valuations between different kinds of markets are somewhat out of whack. And we have done a little trimming last year in that matter. That could well be a mistake. I mean, the real thing to do with a great business is just hang on for dear life. Charlie?
Yes, but the sales that do happen, the ideal way is when you found something you like immensely better. Isn't that obvious? That's the ideal way to sell.
In just a few words, Munger summed it up perfectly. If we find something far better than what we currently own, then it's likely a good time to consider selling, especially if the new option fits in better with your investing goals. Since my goal is to live off of dividends, I focus on investing into dividend-paying stocks. Originally, it was the reason I bought into ACRE, MAIN, and Goldman Sachs Business Development, GSBD. When I first started investing years ago, these companies seemed like great options as they had dividend yields of around 6.5, 11.5, and 11%. I assumed that these high-yielding investments would provide me with the fastest way to live off of dividend income. After reading and researching for over a decade and doing my own analysis, I quickly realized that dividend growth investing provided a much faster path to being able to live off of sustainable dividends while also growing your portfolio at a rapid rate. The big problem with the companies that I sold out of is not that they are terrible investments. The biggest problem is their lack of dividend growth. If we jump over to Seeking Alpha and look at ACRE's dividend history, we can see that their dividend payouts have very little growth over the past 5 years, and it even decreased from 2021 to 2022. The same is true for Goldman Sachs Business Development, who has seen zero growth in their dividend payouts over the last 5 years. The opportunity cost of staying invested into these companies instead of quality dividend growth companies is far too great. It would likely cost me hundreds of thousands in regard to my portfolio value and would undoubtedly delay my ability to one day live off of dividend income. To demonstrate just how large the opportunity cost could be, let's jump over to a spreadsheet I built out for the sole purpose of seeing how fast we can live off of dividend income, and let's compare a dividend growth stock versus a high yielding investment. For our dividend growth stock, you can see our assumptions right here of a price growth rate of 4.5% with $1,000 contributions every month, dividend growth rate of 9%, and a starting dividend yield of just 2.5%. If we jump over to our high yielding investment, you can see we're assuming a price growth rate of 1%, again $1,000 monthly contributions, 0% dividend growth, but a very high starting dividend yield of 9%. And if we jump over and look at our charts, we can see our black line is the cost of living, the purple line is dividend growth, and pink is high yielding dividends. And you can see for a short period of time, the high yielding actually does outperform dividend growth in regards to how much dividend income you receive, but long term, dividend growth absolutely destroys high yielding investments, and it even allows you to live off of dividend income at a faster rate. And when you really dig into the numbers, in this scenario, dividend growth investing would allow you to live off of dividends almost 6 years faster than high yielding investments. So let the investing mistake I made years ago be a lesson to you. Make sure that the investments you are making align with your investing goals. High yielding investments can be effective when utilized correctly, but when utilized incorrectly, it could be a mistake that will cost you greatly. If you want to learn more about living off of dividend income as fast as possible, then I'd suggest watching the video that is linked in the description. If you'd like to be able to download the spreadsheets using this video, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.